What if I told you that today, in the middle of an active regional war, with the Strait of Hormuz physically closed, with Hezbollah firing rockets into northern Israel as we record this, with American and Israeli warplanes still running sorties over Tehran, silver climbed to $96.40, and then stopped dead, pulled back, retreated, as if none of that was happening, as if the world was not on fire. That is what happened today in the silver market, and I promise you, by the time this video ends, you are going to understand exactly why that happened, exactly what it means, and exactly what silver does next. And that last part, what silver does next, is going to genuinely shock some of you. Stay with me. Every single second of this video matters. I need to say something before we go any further. This channel is 3 videos old. We launched into the most volatile commodity market environment in modern history, and in 3 videos we have built something that I am genuinely proud of. A channel that does not recycle headlines, does not tell you what you want to hear, and does not water down the complexity of what is actually happening in these markets. Every video we publish is built on one non-negotiable promise: real data, honest analysis, zero agenda. Today that promise gets tested harder than it has in our first 3 videos combined, because today's silver story is genuinely complex. It is genuinely uncomfortable in places, and it demands the kind of clear-eyed, honest analysis that most financial channels on YouTube simply do not deliver. So if you are new here, welcome. You found the right channel at exactly the right moment. Hit subscribe, hit the bell, and let us get into the most important silver breakdown you will watch this week. Here is the value proposition of the next 25 minutes of your life. By the end of this video, you are going to know 3 things that most silver investors, including many professionals, do not fully understand right now. You are going to know exactly why silver pulled back from $96.40 today, despite an actively escalating war. You are going to know the single most important number in the entire silver market right now that almost nobody is talking about. And you are going to know the exact framework, the specific data points, the specific levels, the specific calendar events that will tell you which direction silver moves next before the mainstream media even reports it. That is what this video delivers. Now let us earn it. Let us start with the scene, because context here is not background noise. Context is everything. This morning, silver opened at $94.26 per ounce. Within 60 minutes, it had climbed $2.14 to hit $96.40 intraday. $2.14 in 60 minutes. Feel the violence of that move for a moment. That is not organic price discovery. That is a panic bid. That is institutional money arriving at the market at the open and competing with retail fear buyers for the same physical ounces at the same moment in time. And then, at $96.40, something cut the buying off like a switch. Silver drifted back, retreated to $95.19 where it currently trades with a gain of 1.68% on the day. Now here is the question that should be burning in your mind right now. In the middle of the biggest Middle East war in decades, with the Strait of Hormuz closed, with Hezbollah firing from a second front, with oil at $82, what on earth was powerful enough to stop silver in its tracks at $96.40? Write that question down if you need to, because the answer is the entire story today. And the answer is going to tell you something about this market that will change how you watch silver for the rest of 2026. But first, and I need you to really feel the weight of this, let us talk about the war. Because what is happening militarily right now is significantly more alarming than the headlines are conveying. On February 28th, United States and Israeli forces conducted coordinated strikes on Iran. Supreme Leader Ayatollah Ali Khamenei was confirmed dead. Iran immediately responded with ballistic missiles and drone attacks targeting Israeli cities and U.S. military bases across the entire region. Multiple waves of strikes followed over the next 48 hours, systematically targeting Iranian military infrastructure, nuclear facilities, and leadership command structures. And then this morning, the moment that changed the character of this entire conflict, Hezbollah opened a second front from Lebanon. Over 150,000 missiles and rockets, airstrikes hitting Beirut, rockets landing in northern Israel, Israeli Air Force striking across southern Lebanon. What began as a bilateral U.S.-Israel operation against Iran has now become a multi-front regional war. The Strait of Hormuz, the 21-mile-wide channel through which 20% of the entire world's daily oil supply flows, has been closed for 3 consecutive days. Goldman Sachs has priced an $18 per barrel risk premium into oil already. Wood Mackenzie is warning of $100 oil if the closure extends past 2 weeks. Brent crude spiked 13% to $82 at Monday's open. This is the world silver is operating in today. This is the fire that was supposed to send silver vertical, and instead silver hit 96.40 and pulled back. Now you understand why I have been staring at this chart for 2 hours. And now you are ready to understand the answer. Here it comes. The answer to the most important question in today's silver market, and it is simultaneously the most fascinating and the most important thing you can understand about silver as an asset right now. Silver is not one thing. It has never been one thing. It is two completely different things living inside the same price. It is a safe haven monetary metal, the thing people run to when the world feels like it is collapsing. And it is an industrial metal, deeply and fundamentally tied to global economic output, energy consumption, manufacturing activity, and supply chain health. And right now, at this exact moment in history, those two identities are at war with each other inside the silver price. On the safe haven side, you have everything screaming buy. Active regional war, second front opened, strait closed, 6 consecutive years of structural supply deficit, 820 million ounce cumulative shortfall, above-ground stocks actively depleting. And on the other side, the industrial side, you have two forces that are quietly but powerfully fighting back: a strengthening US dollar and rising Treasury yields. The dollar is strengthening because when wars break out, global capital runs to dollar assets, US dollars and US Treasury bonds, as the ultimate safe haven. And Treasury yields are rising because the war is reigniting inflation expectations through oil price shock. And dollar strength makes silver more expensive for foreign buyers. And rising yields increase the opportunity cost of holding non-yielding assets like silver. So you have this extraordinary collision happening in real time. War fear pushing silver up toward 97. Dollar strength and rising yields pushing it back toward 93. The 96.40 level this morning was the exact equilibrium point between those two forces. The exact moment they canceled each other out. And that tension, that unresolved battle between two equally powerful forces, is what makes the next move in silver not just important, it makes it potentially historic. Now I need to tell you about a number. A single number that almost nobody in the mainstream financial media is talking about today. And this number, when you fully understand what it means, is going to reframe everything you think you know about where silver is right now and where it is going. The number is 30. Silver lease rates, the cost of borrowing physical silver in the market, jumped 30 times their normal levels during the most recent period of acute market stress. 30 times. Not 30%, 30 times. Let me translate that into the plainest possible language. When institutional investors, manufacturers, and market makers try to source actual physical silver, real bars, real ounces, the metal that actually exists in a vault somewhere, right now it costs them 30 times what it normally costs. That is the market screaming that physical silver is genuinely and acutely scarce. That the gap between paper silver, the futures contracts and ETFs that represent silver on a screen, and physical silver, the actual metal, is widening in a way that has historically preceded the most violent and explosive silver price moves ever recorded in modern market history. The Hunt Brothers corner in 1980, the 2011 run to $49, the 2020 pandemic squeeze. Every single time physical tightness of this magnitude has appeared in the silver market, it has preceded a price move that made everyone who was not positioned feel like they missed the trade of their lifetime. 30 times normal lease rates, in the middle of a war, in the 6th year of a structural supply deficit, with American vaults being physically filled with silver as institutions move to secure supply right now. That is not noise. That is the loudest signal in the entire silver market today, and almost nobody is talking about it. Now let us talk about the two most uncomfortable data points in today's silver story. Because honest analysis means giving you the full picture, not just the parts that confirm the bull case. The first uncomfortable data point is the Oxford Economics War Assessment published today. Oxford Economics, whose clients include the world's largest sovereign wealth funds, central banks, and institutional investors, concluded that while Iran cannot win this conflict militarily, it can inflict material economic damage through sustained disruption of Gulf oil flows. Crucially, and this is the part silver bulls need to sit with, they projected a conflict duration of under 2 months. Under 2 months. Here is why that matters for silver specifically. The war premium that drove silver from 92 to 96.40 this week is built on an assumption of sustained chaos. If the institutional base case, per Oxford Economics, is a sub-2-month conflict resolution, then some of that war premium is on borrowed time. Not all of it. The structural fundamentals remain. But the war-specific premium above $92 to $93 has a timer on it. And when institutional money starts pricing in that timer, the pullback can happen faster and harder than retail investors positioned for continued escalation are ready for. This is the scenario you need to be prepared for. Not because it is certain, but because the data demands you acknowledge it. The second uncomfortable data point is the CoinCodex algorithm. This is the number that made silver Twitter uncomfortable this morning. CoinCodex published a 7-day silver price forecast predicting an 11.07% decline to $79.92 by March 8th, next Friday, $79.92. Now, before you dismiss this, and before you panic, let me give you the honest context. CoinCodex's algorithm is built on historical price patterns and technical momentum. It does not know Hezbollah opened a second front this morning. It does not know lease rates are 30 times normal. What it does know is that silver has moved fast and far and is showing technical exhaustion at a resistance level. And that technical reading is not wrong in isolation. The question, the $5 billion question, is whether the war and supply deficit context overwhelms the technical exhaustion signal. And right now, no one can answer that with certainty. Anyone who tells you they can is lying to you. Here is what the structural supply picture tells us about silver's floor. And this is the data that makes the bear case genuinely difficult to sustain beyond the short term. Silver has been in structural supply deficit for 6 consecutive years. The cumulative shortfall since 2021 exceeds 820 million ounces. The projected deficit for 2026 is 67 million ounces, calculated before the war added additional disruption to already stressed global supply chains. Tariffs created regional dislocations in the silver supply chain in 2025, shipping delays, silver being physically moved from international exchanges into American vaults, lease rates at 30 times normal, and above-ground accessible stocks visibly and measurably depleting. This is not a market where $79 silver can sustain itself for any meaningful period of time, even if the war premium fully deflates. The structural floor is real. The structural floor is data-backed. And the structural floor right now sits somewhere between $85 and $92. Below that, and I want to be clear this is possible but would require simultaneous resolution of every bearish factor in this market, you would need the war to end this week, the dollar to surge past 100 on the DXY, yields to spike significantly, and the Fed to signal it is not cutting rates at all in 2026. That combination of events is theoretically possible. It is not probable. And the 30 times lease rate signal tells you exactly why. Now here is the technical picture because the chart is not just confirming the fundamental story, it is amplifying it. Before the war news broke, silver had already done something technically enormous. It broke above $92 per ounce, confirming the completion of a cup and handle pattern that had been building since the fourth quarter of 2025. The same type of pattern that previously launched silver from $70 to $121.67, its all-time high. That $92 breakout is now confirmed support. Today's pullback from 96.40 did not break below 92. It held the structure. And the key resistance levels from here form a ladder that gets more dramatic with every rung. $96 to $97, today's battle zone. $100, the psychological and technical target that changes the entire narrative around silver if broken. $120 to $121.67, the all-time high retest zone. And beyond that, the numbers that analysts at FX Empire, Intellectia, and institutions cited in GOTV are publishing. $150 in a sustained escalation scenario. $200 if gold achieves its projected $6,000 target and the gold-silver ratio compresses toward 50 to 1 from its current 55 to 1. That mathematical pathway to $200 silver is not fantasy. It is arithmetic applied to observable and documented market data. Now here is the macro calendar because the next 5 trading days are the most important 5 trading days for silver in all of March 2026. Write these down. Today, U.S. ISM Manufacturing PMI. This tells us how the industrial economy is absorbing the war shock in real time. Wednesday, ADP employment change, the preview number for Friday's headline event. Wednesday also brings the Federal Reserve Beige book, which will be dissected sentence by sentence for any language suggesting the war-driven oil shock is forcing the Fed to reconsider its rate path. Thursday, initial jobless claims, a leading indicator of the employment picture ahead of Friday. And Friday, circle it in red, the U.S. non-farm payrolls report, the single most important macro event for silver this entire month. Here is why. According to CME Group data right now, 95.6% of market participants expect the Fed to hold rates unchanged at the March meeting. Only 4.4% are pricing in a cut. But if Friday's NFP number comes in significantly below consensus, if the war uncertainty has already started chilling hiring decisions, that 4.4% probability starts moving toward 20, 30, 40% for a May cut. And silver responds to shifts in rate cut probability faster and more aggressively than almost any other commodity. A weak jobs number on Friday in this war environment, with lease rates at 30 times normal, with the Hormuz still closed, with Hezbollah now in the conflict, could be the exact catalyst that breaks silver cleanly and finally above 97 and sends it toward 100 in the days that follow. A strong jobs number does the opposite, gives the dollar another leg, pushes yields higher, delays the rate cut timeline, and tests silver's support at 92 with uncomfortable pressure. Friday is the fulcrum. Position yourself accordingly. 3 scenarios, all honest, all possible, all data-driven. Scenario 1, escalation. Hezbollah intensifies. Iran launches additional strikes. Hormuz stays closed past 2 weeks. Oil breaks $100. Inflation reaccelerates so hard the Fed rate cut narrative gets pushed to December or beyond. In this scenario, the war premium in silver does not deflate, it compounds. $100 is not a ceiling, it is a launching pad. 120 becomes a realistic near-term target. Bank of America's $309 upper range stops being a talking point and becomes a price objective that institutional money starts seriously modeling. Scenario 2, containment. Oxford Economics is right. Sub-2-month conflict. Strait reopens within 2 weeks. Oil pulls back. Fed stays on June cut path. Silver consolidates 90 to 100, builds a technical base, and then moves higher driven by the structural supply deficit rather than the war premium. This is the institutional base case and the most probable outcome based on current evidence. Scenario 3, rapid de-escalation. Ceasefire brokered through back-channel negotiations. Hormuz reopens within days. War premium deflates fast. Dollar surges. Silver tests 85, and in a worst case briefly touches 82. CoinCodex starts looking prescient. And the 6-year supply deficit creates a structural floor that turns what feels like a disaster into the buying opportunity of 2026. Here is the spectacular bottom line. Silver hit $96.40 today, and then something weird happened. The weird thing was not weakness. The weird thing was a market so perfectly balanced between 2 forces of almost equal and opposite power that it could not sustain a new high even with a regional war actively expanding by the hour on 2 fronts. A 30 times lease rate spike telling you physical silver is acutely scarce. An Oxford Economics report quietly telling the smart money the war has a 2-month timer. An algorithm predicting $79 by Friday. Bank of America sitting in the background with $309 in their model. And NFP Friday coming like a freight train at the end of this week, carrying the power to flip the Fed narrative and break this market out of its equilibrium in one direction with extraordinary violence. The coiled spring is loaded. The tension is real. The next move is coming. And when it comes, it is not going to be gentle. It is going to be the kind of move that defines positions, confirms narratives, and rewards the investors who understood the setup before it resolved. You are now one of those investors. Drop your prediction in the comments right now. Does silver break 100 this week on Hezbollah escalation? Does Oxford Economics prove right and we test 85? Or does NFP Friday flip the entire narrative and send silver through 97 toward 100 and beyond? Every comment gets read personally. We are 3 videos in and we are building the most honest and most data-driven precious metals channel on YouTube from scratch. If this video helped you see this market more clearly than you did 25 minutes ago, hit the like button. It costs you nothing, and it means everything to a channel this size. Subscribe and hit the bell, because this week in silver is going to generate more price action and more critical data than almost any week this year. And you absolutely do not want to watch it without this framework. I will see you in the next one.